All right, Ben, you want to get us started?
Yeah, we're a couple minutes past, so we got a couple of things to touch base on right away, and we can get going. So my name is Ben Tamm, and I oversee all HOA renewals here at Insurance Warehouse. Thank you everyone for taking the time to join us for our second educational webinar, designed specifically for board members and property managers. We're excited for another great turnout with over 200 signups for today. Truly appreciate your participation. This session marks a continuation of our quarterly educational series we're hosting throughout the year, and we look forward to your feedback as we continue to refine and expand on these offerings. Before I turn it over to Eric, I'd like to briefly review a few housekeeping items. Due to the number of participants, all cameras and microphones have been turned off. We'll do our best to keep today's session to about an hour. Eric will present for approximately 40 minutes, and then we'll reserve the final 20 minutes for questions. If you have any questions during the presentation, please enter it in the Q&A feature at the top of your screen. I'll be monitoring the chat, and we'll select several questions to address during the Q&A portion at the end. If we're unable to get to your question today, just let us know, and we'll compile responses to all submitted questions and send a follow-up email to all attendees. That email will also include a recording of today's presentation. So with that, I'll turn it over to Eric.
Thanks, Ben. Thanks everyone for taking their time out of a nice sunny afternoon to join us to talk about all things insurance. Just briefly, a little about Insurance Warehouse. We are a local independent agency here in Golden Valley. We're currently the largest insurer of townhomes and condos in Minnesota with just over 1,600 associations, which ends up totaling over just 80,000 units. And so currently that's $27 billion in total property insured across Minnesota. Our agency developed a program with Fortegra that is exclusive to us in Minnesota that some of you may be familiar with. We also have exclusive access to Berkeley National, and then preferential pricing and underwriting with most of our carriers due to our volume. And then we're active members and speakers with CAI, and we like to utilize an online portal for all of our COIs to make life easier for our unit owners. Just quickly going over the agenda, today we're talking about decoding HOA coverage definitions, going through all-in, bare walls, and the difference between them and everything in between. We'll talk about the hazard of informal language, go through coverage definitions, talk about the path to compliance if you're looking to change your coverage definitions, and then talk about a few claims examples and how they affect both the association and the HO6 policy in the event of a claim. So to start out, there's 4 definitions that we use in Minnesota. These are the 4 that I'll go through pretty quickly here. But before jumping into that, the reason we wanted to talk about this topic today is it's one of the most common questions that we get asked, also one of the most confusing portions of the HOA master policy and HO6 relationship. We get a ton of questions from board members about how this works out, what they have the ability to insure or not insure. And one of the most common misconceptions that we get is that the insurance policy itself actually has language about what it will or won't cover in the event of a claim. So we'll have board members and unit owners alike reach out and say, hey, can you send us the policy? We want to see what it covers on the inside or the outside of the units. In all actuality, the insurance policy doesn't dictate or say what it's going to cover for your association. It simply says something to the effect of, we'll cover whatever the HOA declarations allow or want us to cover. And so a lot of times we get these questions about what's the insurance policy cover? And our answer back to the unit owners and board members are always, well, it depends on what your governing documents say. And so going through the governing documents should be the first place every agent starts when reviewing your insurance. Without the HOA declarations, the specific insurance section that's in there, there's no way for an agent or a board to know what specifically should be covered. So reviewing your governing documents in the insurance section is the first step in insuring your HOA properly. One misconception too is the maintenance section of the governing documents is completely separate from the insurance section. So there might be items that are listed in your maintenance section that are unit owner responsibility, but that doesn't mean that it's their responsibility when it comes to insurance. Decks, windows are a great example where a lot of HOA's governing documents talk about the maintenance of the deck or the windows is the unit owner's But in the insurance section, the insurance actually covers the decks and the windows. So a lot of times we get people confused about what's actually covered, and they're referencing the maintenance section when they need to be referencing the insurance section. So before we dive into the actual declaration examples, these are the four definitions that we see used in Minnesota. Starting at the bottom and working our way up, all-in coverage covers the entire building. So exterior, interior, and betterments and improvements. So if the building was built in the 1970s with shag carpeting and vinyl flooring, and your property now has hardwood floors throughout, the master policy would cover those betterments and improvements and cover those hardwood floors. The all-in coverage definition is probably still the most common, although we're seeing a lot of associations start to shy away from that for reasons we'll talk about later. But most townhome associations were built and set up as an all-in coverage definition when they were originally put in place. And so this is the easiest for unit owners because they don't have to worry about much. They know the master policy covers everything, but there's some downfalls to all-in as well, which we'll talk about later. One step down from the all-in coverage definition is original specification, or also known as single entity coverage. This does the exact same thing as all-in, except it does not cover the betterments and improvements. So this also covers the exterior of the home all the way through the interior, but it does not cover any of those betterments and improvements, whether it's you as a unit owner that installed them or it was installed by the previous owners. The original specifications definition does not cover any improvements made since the building was originally constructed. Modified original specifications from the insurance side, probably our least favorite to use. This is where your governing documents specifically exclude some of the items on the interior, but not all of the items in the interior. We don't like it because it's a little bit of a mix of both, and it becomes difficult for unit owners to understand, is the inside covered or is it not? The answer is kind of, it depends. Certain items are, certain items aren't. And so there ends up being a lot of confusion around the modified original specification definition because the master policy ensures the exterior and parts of the interior, but not all of the interior. And then bare walls. This is the most common coverage that associations are switching to currently. Most condo buildings, so a high rise where there's units on top of each other, have been bare walls coverage definition, but now we're seeing a lot of townhomes start to move over to this definition as well. And so this coverage also has a lot of misconception on where the policy actually starts and ends. And so the master policy covers the exterior of the buildings through the interior up to just the drywall. And so everything behind the drywall, the electrical, the plumbing, the HVAC, all of that is included in the master policy. But once you hit the drywall, that is where it stops. Everything past that is going to be unit owner responsibility. So the carpet, the cabinets, the flooring, the millwork, any of the fixtures, the permanent appliances, any of that is going to be the unit owner's responsibility and should be covered by their HO6 policy. So now that we have the four definitions down, wanted to give you a couple examples of the governing documents and how they read. Now, every HOA seems to have different governing documents. It's not that there's a couple different versions. There's thousands of different versions. Every attorney wanted to put their own little spin on it. And so we see a ton of different versions. I want to give you a few quick examples here so you can get a kind of a good read on the different language, but knowing that you'll have to go back to your own governing documents to review and see what you're allowed or not allowed to do. So in this first example here, the highlighted portion is common, and this is taken from the Minnesota Common Interest Ownership Act, where it says the association may or need not insure the betterments and improvements referred to in section 515B. And so in section 515B, they list out all of the items in the interior as improvements and betterments. So this language allows the board to choose. They could choose not to insure them and be bare walls. They could choose to insure them and be original specifications, or all in. And so this language here allows the board members to choose. Next, this one also allows the board member to choose, but it specifically lays out all those interior items. So again, it has the may or may not insure language, and then specifically list out all the items that the board may or may not insure. You decide to exclude all of those items, then you would have a bare walls policy. The board could also pick and choose which items they want. making it modified original specifications, or include all of it and be original specs or all in. Next, we have a good example of a modified original specifications policy. This specifically tells the what the unit owners have to insure. And so it says that the unit owners have to insure carpet, wall covering, fixtures, furniture, furnishings, etc. And so this does leave out a couple items, and those items, so it says carpeting, but it doesn't say flooring. It doesn't mention millwork or appliances, and those items would be covered by the master policy because they're not specifically excluded by the governing documents here. And then last but not least, this one specifically says the insurance coverage is to cover everything up to 100% replacement cost, but not including, and then it lists the following items. So it specifically says that all of these items, the ceiling, wall finishings, floorings, etc., are not to be covered by the master policy. So again, going through this conversation, it all leads back to your governing documents. You got to go back to your governing documents, find that insurance section. It can be, 1, 2, 3 pages typically. There should be a section in there that specifically talks about what your coverage should have. There are a lot of declarations that are somewhat ambiguous. It doesn't have any of this information in there of these last 4 examples. The ambiguous language leaves it a little bit up to interpretation. And so working with your insurance agent, also potentially consulting your lawyer, is important to know which coverage you can or cannot choose. And so starting your insurance process, anytime you're working with your renewal or a new insurance broker, starting with the governing documents and reviewing this section is the first place to start. So once you've gone through your governing documents, you may be handcuffed to a certain kind of coverage, or you may have the ability to pick or choose. And so depending on what your governing documents say, you really have 2 paths to compliance in making sure that if you do want to change what the master policy covers, which route do you go? So if you're one of the lucky associations where you do have the choice, the resolution is all you need to do as a board. And so this does not require an attorney. This does not require going through a formal voting process with your unit owners. Because you have the language in your governing documents that allows the board to choose, the board should simply use a resolution similar to the one here to clarify what the board's intent is. And so without this, it can get a little sticky in claim scenarios. And so having some sort of documentation stating the board would like the policy to cover this or not cover this is extremely important. This is a simple 1-page resolution that we use all the time for a board to decide, and they can elect to include these items listed here or not include these items listed here. It's still important to go through your governing documents and make sure what is allowed and what's not allowed before doing a resolution. We see a lot of associations want to just jump the gun, use a resolution, even though their declarations specifically state what coverage they have. And so knowing you can only use this resolution if the declarations give the board a choice is extremely important. When we see a change in coverage definition, attorneys typically state that you need to give unit owners 30 days notice. So although you have the ability to sign this and change coverage overnight, giving the unit owners ample time to get the information, go to their HO6 carrier, and increase their coverage is extremely important. So going through this process, if you're looking at changing your coverage definition, your declarations allow it, know that you should be giving your unit owners at least 30 days notice. Next, we have the amendment. So if your governing documents specifically state that you have to have a certain amount of coverage, like that last bare walls example where it said we're not including any of these items, and the board decides they want to include those items, you have to go through a formal amendment. And so if you're new to the board or haven't gone through an amendment process yet, it's not as easy as the resolution. This one requires an attorney. So we did reach out to Smith, Jaden & Johnson. They do a ton of these for associations and are one of the more prominent law firms, specifically for HOAs in Minnesota. They said this typically takes about 4 to 6 months. They said it can take 8 months to a year, depending on how quickly or slowly the association moves. But if the association is motivated, it typically takes 4 to 6 months. While doing it, they typically recommend that you amend any other changes you want in your declarations as well. And so if you're going through and changing one thing, You should look at any other stuff that maybe is out of date or needs to be updated so that the association can function a little easier. This does require all unit owners to vote, and it does require a 67% acceptance in order to pass the amendment. So going through this process takes time because you do need to get the attorneys involved. Proper notice needs to be sent out to everyone, every unit owner to vote. You need to collect those votes, and then you need to go through the process, assuming that the votes went your way, of actually going through and rewriting things. And so if you're going to look at changing coverage definition, it's not just something you can do overnight. It's something that needs to be prepped, possibly a year in advance. So if you look at your current renewal and you're looking at changing to bare walls, know that your declarations might require a formal amendment, which could take 4 to 6 months or maybe longer, depending on how quickly you and the attorneys can get things moving. So this is a graphic we like to use. I think a lot of people like the visuals better than going through and listening to it all. And so I think this is a great example. Again, as Ben mentioned, this will all be sent out after. And so something you can look at down the road if you need to. But as we proceed into the claim scenario, I think it's important to look at this graphic. And so as you can see on the left, you've got the bare wall side where it's just the subflooring, there's drywall, and then it's left up to the unit owner to take care of anything from there. On the right, you have the all-in coverage definition, which includes your lovely hardwood floors and your kitchen and your appliances. And so a couple of the notes at the bottom, I think, are the key takeaways for today on why an association would look at moving from an all-in or original specifications to a bare walls policy. So the biggest advantages of moving to bare walls is that it reduces your claims exposure. So first and foremost, now that the master policy is not paying for that hardwood floor or paying for those cabinets, if there's a claim in the interior of the unit and the association's policy is no longer paying for those things, it significantly reduces the master policy's exposure to claims. And obviously, keeping claims off your claims history makes life easier for the board going forward. It makes sure you don't get non-renewed, helps you find different other carriers, potentially suitors down the road. And so keeping claims off the master policy is extremely important, and moving to bare walls does that. It also lowers premiums. So now that you're not covering the inside of the unit, you're not paying for floors, you're not paying for countertops, it decreases the value that the insurance company needs to insure your property for. And so that can help lower the premiums. Typically, we see about a 15 to 20% decrease. And then it can potentially make you eligible for more carriers, which we'll go through an example on in the next slide. But now that you're reducing your building values, that can also help you find some additional carriers. And so moving to bare walls has been a very popular conversation over the last 2 to 3 years as insurance has become one of your largest line item budgets. Everyone's looking at ways to not only reduce costs, but reduce exposure to help eliminate some of the smaller ticky-tack claims that have plagued some associations. And so this conversation came out of all of the associations looking to at least start the conversation about how can we make our insurance less expensive, or how do we make ourselves potentially more eligible for carriers. So in this next slide, it's an example of an association that is currently insured for an all-in master policy with a total building value of $31 million. They go through the process of transitioning to bare walls, and that drops their total insured value down to $24.3 million. This results in a 22% premium in reduction, which is great. But then also, just as important, with the additional savings, it also makes them eligible for more carriers. We have a lot of carriers that focus on the size of the association as one of their underwriting guidelines. And so when they were at a $31 million association, there's a handful of carriers that cut off at 25 million or 30 million. And so moving to bare walls then drops them to 24.3 million. Now they're all of a sudden eligible for those carriers. And so not only do you immediately see a 22% reduction in premium, but now may also have a couple additional options that may help you save even more money if those carriers are more competitive. So moving to this bare walls option can definitely make a positive impact on your insurance and your renewal options. So claim scenarios. The all-in versus bare walls, the first one is a water damage claim. And so if a pipe breaks behind the wall of the kitchen, causing damage to the unit, the cabinets, the counters, the flooring are all damaged, and the replacement cost is $55,000. The drywall and subflooring are $20,000. And so on the left, you have the all-in example. On the right, you have the bare walls example. So going through on the left side here to start, we have 55,000 in damage to the interior. We have 20,000 in damage to the structure. So we have a total of $75,000 in damage. Let's say this association has a $25,000 deductible. You would take that 25,000 out of the total. That 25,000 would then come from the unit owner, and then the master policy would be responsible for the $50,000 above that deductible. And so the total of 75,000 is covered between the HO6 and the master policy. On the right, the $55,000 in interior damage is the unit owner responsibility. So that's not factored into the equation when looking at the master policy and the deductible. So you still have 75,000 in total damage, but only 20,000 in structural damage. You have a $25,000 deductible. So that 20,000 doesn't exceed the master policy deductible, and therefore the master policy would not come into play. And so in this claim scenario, you would have the master policy payout 0 and the HO6 policy payout $75,000. And so, as we talked about in the previous slide, having a bare walls coverage definition can significantly reduce your claims exposure. And so in these examples, a $75,000 claim that was going to hit the master policy in an all-in coverage definition doesn't hit the policy at the bare walls. You avoid a claim, and the HOA master carrier doesn't have anything to worry about next year. So next we have the all-in versus bare walls with a fire damage claim scenario. So a fire causes significant damage to a unit. The flooring, the cabinets, the countertops, fixtures, appliances are all damaged. The replacement cost is $250,000. The drywall, the ceiling, the subflooring, and the framing total $125,000. So again, on the left, you have the all-in coverage definition here. We've got $250,000 in damage to the interior, and you have $125,000 in damage to the structure, for a total of $375,000. Again, you have a $25,000 deductible, so the unit owner would be responsible for that $25,000. You take that out of the total, the master policy would be responsible for $350,000. On the right, we have the bare walls example. So again, the unit owner is responsible for the interior, so that $250,000 is the unit owner's responsibility. The $125,000 is going to be responsibility of the master policy. So again, you got a total of $375,000, but only $125,000 applies to the master policy. You have your $25,000 deductible. And so in this scenario, the HO6 would pay for $275,000 and the master policy would pay for $100,000. So I think in both claim scenario, whether a small or large claim, you can see the difference between the all-in and the bare walls and how significantly reduced the exposure is for the master policy in a claim scenario like this. I think it's the biggest reason why an association should look at moving to bare walls. Yes, saving the money is nice when you reduce your overall premium. However, your unit owners will have to pick up some expense increase in their HO6 policy. And so you are moving a little bit of money from your one pocket to the other pocket in that scenario. And so doing it just for the financial impact isn't always the best way to look at things. I think the claims exposure is the most important factor in this decision of moving from all in to bare walls. Going forward, your association will have significantly less claims. It will make sure that your HOA policy with the current carrier, you avoid those smaller claims. You should get better renewal terms. You should avoid getting non-renewed. And then when you look to shop, your claims history will be a lot more favorable. Taking some of the smaller claims out of the equation also makes your job as a board member and a property manager that much easier. If some of these smaller claims, like the water damage claim before, is confined to a single unit, doesn't involve the master policy, the whole board doesn't have to get dragged into the claim scenario. The unit owner can work with their HO6 carrier and get things handled on their own. So when having the conversation about moving from all in to bare walls, know that reducing the claims exposure, it could be the most important factor for your association and the longevity of their master policy going forward. So HO6 changes, I mentioned them very briefly. knowing that if you're going to make a change like this, it significantly impacts your unit owners. We've seen a handful of associations make the change only to just have a claim down the road, and a unit owner either wasn't aware or they didn't get proper insurance because they didn't get the notification. And so making sure that you go through and do the 30-day notice is extremely important. Making sure they get that information that there has been a significant change, that they're now responsible for the interior of their buildings is extremely important. What they will need to do in this scenario is they need to increase their coverage A. So this is their building coverage. They're going to have to work with their they're going to have to work with their insurance agent to figure out what the interior of their unit is going to cost. And so every unit is different. There's some that may have updated to hardwood floors and bamboo countertops, or bamboo floors and lovely countertops, where someone may still have the original linoleum floor and Formica countertops. So having a blanket statement of everyone needs to have $200,000 of interior coverage is tough to do. Unit owners will need to work with their agent to come up with what kind of coverage they need for their interior. This will be going through talking about how much square footage they have, what type of finishes they have, something that they'll have to do with their agent to make sure that they have proper coverage for the claim scenario where they're going to be responsible for that interior. They need to make sure that they have all the right coverage. They need to increase their sewer and sump pump as well. And so sewer and sump pump is automatically excluded from coverage in all policies and needs to be endorsed onto a policy. And so going to a bare walls policy where you're now responsible for all the flooring and the millwork and the paint on the walls in your basement, having sewer and sump pump coverage is extremely important. And having it endorsed onto the policy is necessary if you ever have a sewer or sump pump claim. And then lastly, the increases we see, it really varies by carrier. So there's 50 plus HO6 carriers in Minnesota, where we've heard some where the unit owner moved from all in to bare walls and it only cost them a few dollars. We've heard others where it's cost them $1,000+. And so from on average, we've found that about $250 a year is the total that we've seen on average. And so when you're going through the process with your unit owners, know that some are going to see very minor changes, others are going to see very large changes. The good news is that there's a ton of HO6 carriers out there. So if you are one of the carriers that has a significant increase, you have the option to look for different carriers. So you're not handcuffed to just that one carrier. If you do see that $1,000 increase, it'll be something that might be worth shopping out. And so next slide here is just moving on to questions. I had planned to wrap it up a little bit early today with the nice sunny weather out. We wanted to make sure that everyone got their questions answered and can get on with their day. One of the first questions I already got emailed over ahead of time was just for a quick market update. So it doesn't tie directly into the all-in and bare walls conversation that we're having, but as the market continues to change, we're constantly being asked, what we're seeing and if we can look into our crystal ball going forward, what it's going to look like. So before we get into the questions that Ben's taken a look at and will help go through, quick market update for everyone. We are seeing the market continue to soften. And so from the beginning of the year, we've seen carriers come into Minnesota, start to write policies, be more competitive. We're seeing pricing continue to go down. We're starting to see carriers offer less than a 5% wind hail deductible, where we haven't seen that in the last few years. Everyone's been forced to move to 5%. And so we continue to see more carriers. We continue to see more aggressive carriers. We start to see the lower wind hail deductibles, and then we're starting to see carriers reduce or change their underwriting guidelines. And so where carriers had focused on the age and the size of the association, we're seeing them start to look at a little bit older associations, a little bit larger associations. We're also seeing them start to loosen some of their other underwriting guidelines, most importantly around grilling restrictions. And so grilling restrictions had been one of the hot button topics that carriers were pushing the last few months or last few years. Had become a thorn in all of our sides, having a carrier tell you have to grill 10 feet away from the buildings or they're no longer allowed on decks. And so thankfully, we're starting to see a lot of that being walked back, and we're seeing carriers that don't care about grills any longer in order to be competitive, they've had to drop their grilling restrictions. And so all positive things that we've seen in the marketplace so far in 2026. We did have a little hailstorm just a couple days ago, last Friday, that hit some of the counties in the North Metro, but I don't think it will be too impactful. If we continue to go through the summer without any major hailstorms, I think we can expect this momentum to continue. We'll start to see competitors become more and more competitive. Carriers like to be the most competitive in the fall after hail season is done. And so if we're seeing all these positive impacts already this year, before hail season and into hail season, I think as long as we have another decent summer without a major storm, we'll start to see carriers be even more competitive this summer, or this fall. So hopefully we can make it through without significant hail, and we can continue to see some of the lower rates and the more competitive underwriting options from our carriers. So with that, Ben, do we have any questions lined up already?
Yeah, we had a couple come in and a couple emailed in before. One quick one to touch on, with traditional coverage form language stating, specifically for bare walls, it will not cover ceiling finishing materials or wall finishing materials. Can you touch on whose responsibility the sheetrock is?
Yeah, good question. So the sheetrock is going to be under the master policy at all times. So any coverage definition, including bare walls, is going to include the sheetrock, and it actually includes one coat of primer paint as well. So sheetrock and everything behind it are covered by the master policy in the bare walls claim scenario.
Next, what if we move to bare walls and unit owners don't have the right HO6 coverage in the event of a claim?
Yeah, unfortunately, we see this happen every so often. Unfortunately, unit owners aren't all responsible, or they don't read, the letters that get sent out from us as the agents, or communication from the board or from the property management company. And so the big exposure to the association moving to bare walls is that it puts more responsibility on the unit owners. And so if you do move to a bare walls scenario, I think over communication is key, whether it's an email blast, a mailing, posting on the website, in the annual move-in packets. All of that is extremely important to do, because if someone does get caught in a claim scenario without the right coverage, it can be extremely detrimental to that unit owner. They're responsible for the cost out of pocket. So we've had a handful of claims where maybe it was a fire or a water claim. The master policy will come in and treat things as the language says, and they'll cover the exterior up to the bare walls, and handle things through the drywall. But just because that unit owner doesn't have proper coverage or any coverage doesn't change anything that the master policy adjuster does. And so if that person doesn't have sufficient coverage, they now have to pay for their flooring and their cabinets and their countertops out of their own pocket. We've just recently seen a fire claim scenario in one of our associations where they ended up having to foreclose on the unit owner because they didn't have proper coverage. The interior of their unit was just decimated by the fire. It was going to be, $250,000 to $300,000 to redo the interior past the drywall. The unit owner didn't have that money sitting around, and so they ended up just having to walk away from the unit, and ended up getting foreclosed on. So it is the unit owner's responsibility. Hopefully the unit owners take that responsibility and get the right HO6 coverage, but if they don't, it unfortunately falls on them, and they're out of pocket for those expenses.
Okay. Now, with switching to bare walls, obviously there's a big risk transfer. So with that, are there carriers that give a discount or incentivize HOAs for going with bare walls?
Yeah, we're starting to see a couple carriers that offer some additional pricing relief for moving to bare walls. So obviously, we talked about when you're changing the building value, you'll automatically see some decreases there because the insurance company is just insuring less. But these carriers have seen the data, and knowing that they are involved in a lot less claims, we're starting to see carriers offer some small pricing relief if they are bare walls associations. So not only do you save that 15 to 20% just by reducing the building values, you'll also save, with these carriers, potentially a little bit more because they know that their claims exposure is reduced.
Okay, and it looks like we got one more. So with reviewing all the governing docs, the declarations, the bylaws. Obviously, language can get pretty complicated. Is there somebody that can review or who can review the declarations to see what coverage we need to have?
Yeah, so there's unfortunately not a lot of people that can read them and know what they're actually saying. And so attorneys are obviously the best people. They are the ones who wrote them. They can look at it and tell you what needs to be done or what coverage you need to have. We also look at a lot of them as well. So over the years, we've looked at thousands. And so we're pretty good at knowing what the declarations say. Again, some of them can be very direct and we can tell you pretty quickly, this is the coverage you need to have. Others can be somewhat ambiguous and leave it up for interpretation, and that might be needing to be kicked back to the attorney, whether it's the attorney that originally wrote them or the attorney that you're working with. I think they're always happy to review them and go through things if there's any clarification needed. So yeah, not a lot of people can look at them. Typically, it's not something that the property manager is going to know specifically on either. So we're happy to take a look at them before you got to go spend money on an attorney. Or if it becomes one that's difficult to read or understand, it might result in going back to the attorneys. So is that the last one, Ben? Did we get let off pretty easy with only 4 questions?
Yeah, only 4 questions. There's a couple in the chat that I'll respond to quick and briefly. So I think that covers the big ones.
Okay, perfect. Well, we wanted to make this short and sweet for everybody, knowing that you got more important things to do on a sunny day than listen to insurance. Hopefully it answered a lot of your questions for you. If there are follow-up questions or you have more discussion with your other board members and want to reach out, we're always happy to go over some of this in more detail or more specifically for your association. We're happy to run through it and be a resource for you. So look for this video to be sent out to everyone and then also a survey to come out. And so let us know what you guys want to hear about next. There's always questions popping up. We're happy to cover whatever you guys think is most important. So be on the lookout for that survey. Let us know what you want to see in the next one in a couple months. And we'll be happy to go over whatever you guys think is best. So thank you again for joining us tonight. And hopefully everyone has a great rest of the afternoon and evening.